Hello, class. Welcome back for Chapter 3, Part 2 of Income Inclusions. Rent and royalty income is included in gross income. The rent and royalty income is going to be reported on your Schedule E, and then that's going to flow through to your 1040. Security deposits are not income if they're refundable. So if someone gives a security deposit for you, your landlord, and you're renting, that would be a liability. Same thing as is treated in the accounting world. So you would not recognize the security deposits. That is not income to you. It's not taxable to you. Improvements by lessee are not includable into lessor taxpayers' income unless improvements were in lieu of rent. If fair market value improvements not includable, then lessor has zero basis in property. So the improvements by a lessee are not includable into the income unless the improvements were in lieu of rent. So it would work like this. It would be you are collecting $800, let's say $800 a month from your tenant. And the tenant says, hey, I got a problem with my sink. The plumber's going to come and fix it for $800. You say, okay, great. So instead of paying me, just take care of it. So being that it's going to be taken care of, and instead of rental income in the form of cash, they're going to be having work done. You're going to include that as your income. Okay. If fair market value of the improvements are not includable, then the lessor has zero basis in the property. So if they're not including that, then you would not add that on. And so if you had work done on your apartments, you will not gross up what your property's value would be worth if it's not included. Okay. Dividends generally included into gross income. C Corps can exclude between 50 to 100% of dividends under the dividend received deduction, the DRD. Individuals, dividend rates are capped. Also with dividends, capital gains and dividends and distributed by mutual funds are reported on the 1099 DIV, the 1099 DIV, and are treated as capital gains and losses. That's going to be on your Schedule D, which will flow through to your tax return, your 1040. Constructive dividends is a treatment usually asserted by the IRS. It occurs when employee shareholders are determined to have either unreasonable compensation or unreported benefits. If dividend treatment is upheld, then employee shareholders recognize as income and corporation does not obtain a deduction for the value of the deemed dividends. Payments incident to divorce. So you have child support, property settlement, and then you have alimony. All right. So with alimony, it is not deductible to the payer or the payee. And that is after 12/31/18. So as of 1/1/2019, if you were divorced January 1st, 2019 going forward, you can't deduct the payments for alimony, and the person receiving them does not include that as income. Okay. Before 1/1/19, it is deductible and it's includable. Okay. Property settlements are not deductible or not includable. That has nothing to do with when the divorce is. And child support payments, you can't take that off as a deduction for your child support, and the person receiving the child support is not included as taxable income to them. Must meet all of the following criteria. Payments got to be in cash. Incident to divorce, separation, or written agreement. So you have to have a written agreement. Payments terminate at death of payee. Clearly designated as alimony, and agreements made between people in separate households. Can't be living together. Can't be you can't be divorced, but yet you live together and you're paying uh, your ex. That doesn't work. Um, you have to have a written agreement. When there is alimony involved, I normally ask for the divorce decree from my clients. So this way we have that on file if anything ever came back. Other items in gross income, you have life insurance. The face value of insurance proceeds received incident to death is non-taxable. Okay, so the interest off of it or any kind of a life insurance policy that there is generating any kind of income, you would get that. But you can't deduct insurance payments same way you do not include insurance income. Discharge of indebtedness, that's the forgiveness of amount of a loan, is taxable income. So if you had credit card debts and the credit you stop paying them and you wind up filing for bankruptcy, and the credit cards say, okay, you're going to receive a 1099 for that, and that is going to be included for income. So those people that walked away from mortgages when the housing market crashed and they just walked away, that money that was on those mortgages that was still owed and forgiven, that has to be included as income. Okay, so just keep that in mind. Generally taxable to the recipient, the pass-through income. So you have the partnership income, an IRD, trust income, and S Corp distributions. We talked about with the partnership income and the S Corp distributions, they're going to be coming through. Remember, they pass through as K1s, and that's going to be reported on your Schedule E. Others is prize awards, treasury, trove, lottery, and gambling winnings. That's all taxable income. You hit at the slots, you got to report that. You'll get a 1099. They'll give you that. If you win, if you go on a game show and you win a car, that is definitely taxable. If you guys know or watch Survivor, Richard Hatch, he wound up going to jail because he committed fraud when he did not include his winnings on that first year Survivor. So just keep that in mind. Illegal income amounts are taxable. Unemployment compensation creates taxable income. The illegal income is a huge loophole. If you follow on the different mob stories, that's how Al Capone was captured. They couldn't get him, and the same thing with John Gotti. They could not get anything to stick with them, but they were wondering how they had all this money. So even though it was illegal, it's still taxable and it wasn't claimed, and that's why those guys got caught and went to jail. Calculating taxable Social Security income. Here's your flow chart. So you have it include the lesser of 85% Social Security benefits or 85% of provisional. Does the taxpayer fall between the thresholds? So you're going to have these thresholds here. Include lesser of the 55% Social Security benefits or the 55 provisional income. Is the taxpayer's income less than the minimum threshold? So that's 25,000, 32,000, married, filing apart, head of household. If it's no, then it goes up there. Social Security benefits are not taxable if yes. If the taxpayer married filing separate, but living together, if yes, then you're going to go back to the Social Security benefits or the provisional income, whatever's less. So I know I went backwards. I started at the top. Sorry for the confusion. This is how you're going to calculate your provisional income. Okay. So again, you're going to include either your Social Security benefits or 85% of your provisional income on that. Okay. And then follow this flow chart and we can discuss when you have more questions on this. Insurance proceeds and court awards. Generally, insurance proceeds and court awards are taxable. Includes insurance proceeds for lost profits. The exception is proceeds to compensate for destruction of property to the extent of basis. Part of an involuntary conversion under Section 1033 to the extent proceeds are fully reinvested. Court awards are generally taxable. Exceptions: payments on account of physical illness or sickness, physical injuries or sickness. So if you were out of work and because you got hurt on the job, that money that you should have received, but you were hurt and didn't work, that would not be included. Okay. Recovery of previously deducted amounts. Generally, recoveries are includable in income if the amounts have been deducted in a previous year. Example: Cindy pays $1,000 in state taxes in 2018 through wage withholdings. She deducts the $1,000 paid on her Schedule A for 2018 federal tax return. She received, when she filed her 2018 state return in 2018, she received a $200 refund, which was paid to her in 2019. She recognizes the $200 as income in her year of the 2019 federal return. So it's when it was received. Claim of right: taxpayer must include in income unrestricted funds, even though the amounts are disputed and potentially must be refunded. If taxpayer later must pay back some of all of the funds, then you can deduct the amounts that are refunded. If the refund is more than $3,000, the taxpayer may reduce current tax by actual tax paid on the refund. Okay, so taxpayer must include this income unrestricted funds, even though the amounts are disputed. All right, so how it'll work is, if you're going to dispute it, you still include it to begin with, and then you'll have to come back and back it out if you get a refund. All right. This is going to conclude part 2 of chapter 3, and we will go further and talk about it more in the upcoming lectures. Thank you, and have a great day.